Hello everyone, welcome to an introductory course on basics of stock market, stock analysis and support and resistance by Hindustan Stock Market. So this entire course have 3 sessions and every sessions have different contents. So let me take you through all the sessions and all the contents that I'll be covering in this course. In this first session, we are going to discuss about basics of stock market. See, if you want to invest your money in Indian stock market or if you want to become a trader, you must aware about some basic terminologies which are frequently used in Indian stock market. That is, what is share, who is the shareholder, what is stock exchange, index, Sensex, Nifty, initial public offering, primary market, secondary market, who are stock brokers, what is demat account, and the concept of intraday trading, bull market, bear market, market capitalization, etc. And in the second session, we are going to discuss about stock analysis. That is how to select a stock to invest in Indian stock market. Here we are going to discuss 8 important parameters on how to select a stock, and by following these parameters, as an investor, you can select a stock to invest in Indian stock market to avoid loss and make consistent returns. These are the 8 parameters that you should assess. So the first parameter is you must assess whether the company is fundamentally, that is financially strong or not, whether the company is worth investing or not. That you can assess through some financial ratios such as earning per share, price to earning ratio, price to book ratio, debt to equity ratio, price to sales ratio, current ratio, and dividend yield ratio. And the second parameter is you must understand the kind of products or services that the company is offering, and you must select a company which is having long life, that you should check, and invest in companies with moat. That means the kind of strategy that the company is following, whereas its competitors cannot beat the company just because of the strategy that the company is following, and the unique selling point of the company, that you should check. And you must avoid investing in companies which are having huge debt, right? Before investing your money, you should check whether the company is having huge debt or not. And you must check the efficiency of the management of the company. So here we will follow some parameters to check efficiency of the management. So, and the last parameter is popularity of stock. So these are the parameter we must follow before selecting a stock. And the third session, that is support and resistance. See, trading is a probability. Trading is not a certainty like your maths. See, in mathematics, what happened? 1 plus 1 is always is equal to 2, right? But we cannot expect that kind of certainty in trading. So, if you want to become a successful trader, you must follow a strategy which is having high probability ratio, right? Because in trading we cannot expect any strategy to work 100%. So that's the reason, if you want to become a successful trader, you must follow a strategy which is having high probability ratio, that means which works most of the time. So support and resistance is one such strategy which is having high probability ratio, right? So in this session we are going to discuss about the concept of support and resistance, and we will also talk about principle on which support and resistance is based, and various tools to identify or mark important support and resistance levels on your chart. That is trend lines, pivot points, central pivot range, swing highs, swing lows, supply and demand zone. Like this, there are many tools which are available to identify important support and resistance level. So these are the various contents we will going to discuss. We are going to cover in this course. In this first session, we are going to discuss the most important and frequently used terminologies in Indian stock market. So the first term is share. A share is the part ownership of a company and represent a claim on the company's assets and earnings. So let's say if you own a share of a company, then you are also the owner in the profit of the company and its assets like building, patent, copyright, etc. And as you acquire more stock, your ownership stake in the company become greater. For example, Reliance Industries Limited, which is managed by Mukesh Ambani Group. It has around 6.45 billion shares. Out of 6.45 billion shares, around 49.38% is owned by promoters and promoters group, that is by Mr. Mukesh Ambani and his family. Rest 51.62%, which is owned by general public, right? If you buy one share of Reliance Industry, then you are 1 by 6.45 billionth owner of the company. This is very less. But however, if you keep on buying more shares, let's say one share you buy 10, 100,000 lakhs, then your ownership in the company increases. And obviously, you can see that the promoters, that is Mukesh Ambani's group, they are owning around 49.38% of stake in the company. But if you can buy more and more shares of a company, then your claim in a company will also increase. So basically, a share is a part ownership of a company. Next term is shareholder. A shareholder is an individual or an institution or a corporation that legally owns one or more shares of the share capital of a company. For example, I own 10 shares of Tata Motors and I am a shareholder of Tata Motors. And similarly, if you buy shares of any company, let's say Hindustan Unilever, Maruti Suzuki, HDFC, then you can also become a shareholder of that company. And the shareholders have a claim on the company's ownership. So all the people who own the shares of the company are called shareholders. The next term is stock exchange. Stock exchange is a place where shares of public listed companies are traded. So just like a vegetable market where buyers and sellers meet to buy and sell vegetables, a stock exchange is also a place where the stock buyers connects with the sellers to buy stock. For example, as I said, I own 10 shares of Tata Motors, and if I want to sell those 10 shares, I have to go to the stock exchange. And let's say someone else want to buy the shares of Tata Motors, so he can connect with me to buy the shares of Tata Motors over the stock exchange. Now, an important concept to understand here is that in a vegetable market, the market does not own the vegetables. And similarly, stock exchange also does not own the stocks. The stocks are owned by the investors, that is the sellers, and similarly, after they sold the stock, it will be owned by the buyers. Therefore, stock exchange does not own any shares. It is owned by the buyers, sellers, and investors. Now there are two major stock exchanges in India. The Bombay Stock Exchange, which has around 5,400 registered companies, and the second one is National Stock Exchange, that has around 1,700 registered companies. Let's move to the next term, that is index. A stock market index is a statistical measure which shows changes taking place in the stock market. See, there are thousands of companies which are listed in the stock exchange. Hence, it is difficult to track each and every stock to evaluate some market performance at the time. And hence, the smaller sample is taken, which is the representative of the whole market, and it is called index. So, if you want to know any specific market or any specific sector, how they are performing, then you can look at their index. It helps in the measurement of the value of a section in the stock market. And the Sensex and Nifty are the indexes of Bombay Stock Exchange and National Stock Exchange. So let's understand Sensex and Nifty better. Sensex, which is also called as BSE 30. It is the market index consisting of 30 well established and financially sound companies listed on Bombay Stock Exchange. So basically it consists of 30 companies, and if all the 30 companies are doing well, that is the stock of majority of these 30 companies are doing well and going higher, then Sensex will also go high. And it is said that the market is doing good. On the other hand, if the stock price of the majority of these 30 companies are going down on a particular day, then the Sensex will also fall. And we can conclude that the market is doing bad. Overall, it is an indicator of market movement. Next, Nifty. So Nifty, which is also called as Nifty 50, it is the market index consisting of 50 well-established and financially sound companies listed on National Stock Exchange of India. Now again, if the majority of 50 companies are going higher on a particular day, then Nifty will also go high. And if the majority of the 50 companies in the index are going down, then Nifty is also go down. This is what investors talk when they talk about Nifty or Sensex going high or low. Now, these 50 companies are selected on the basis of free float market capitalization. So, all the big 50 companies who has a very large market capitalization are selected in the index of Nifty. The next term is initial public offering or IPO. It is also called as going public. When a privately listed company offers its shares first time to the public to enter the share market, then it is called initial public offering or IPO. For example, companies like Flipkart or Paytm, they started very small as a startup and now they are growing bigger. And if they want to enter the stock market and sell their stocks to the public, then they have to offer IPO. That is, they have to go public. There are lots of reasons why companies offers its IPO. One of the biggest reason is to raise funds from public. Now going to stock market, a company can meet a lots of investors, millions of investors, and this is one of the best way to sell the shares and get funds from the public. Another reason for going public can be if a company wants to get rid of their debts. For example, let's say initially in order to grow a company took a lots of debt from the banks or any other private lender. Now they want to get rid of their debts. They offer shares to the public and get money from the public and get rid of their debts. So there are number of reasons for a company to go public. But as I said, one of the biggest reason for going public is to raise funds. Now let us understand another important concept, that is primary market. It is also called as new issue market. Primary market is a market where shares are issued and public buys shares directly from the company, usually through an IPO. For example, let's say Bajaj Energy goes public for next year, so it has to go public through primary market. They have to offer their shares for the first time to the public, and your company gets the amount on the sell. So let's say Bajaj Energy sells their 50 lakh shares to the public. All the money that they get by selling the shares will get in the account of the company. So basically, primary market is a new issue market. Besides, let's say the company offers new additional shares in future. So again, this new shares will be offered through primary market only. The next term is secondary market. It is a place where already issued shares are traded. And the secondary market involves indirect purchasing and selling of shares among investors. So here the company has nothing to do with the secondary market. If a company has sold the shares, then the investors who have bought the shares, they can sell and buy shares among themselves, and the money that they get from selling of their shares is credited to the account of the investors. So basically, once a company offers its shares through IPO, it goes through primary market. After that, it is traded among the investors or public through secondary market. And both these occurs only in the stock exchange. And here in the secondary market, brokers are the intermediaries. So next, let's understand what are stockbrokers. A stockbroker is an individual or an organization who is a registered member of the stock exchange and are given license to participate in the securities market in place of its clients. So, if you want to buy shares, you do not need to go to the stock exchange. And nowadays, using online broker, you can buy and sell stocks using your mobile phone. So few of the famous stockbrokers in India are Sher Khan, Motilal Oswal, Zerodha, ICICI Direct, IIFL, Angel Broking, Axis Securities, Kotak Securities, Carvey Stockbrokers, HDFC Securities, etc. So, in order to trade in the Indian stock market, you need to have a broker. That is, you need to open a brokerage account. The next term is demat account. See, this is again one of the most frequently used term. So, demat account is the short form of dematerialized account. It is similar to your bank account. Just as money is kept in your bank savings account, similarly, stocks are kept in your demat account. So in the earlier time, people used to have paper certificate for stocks. That is, when you buy stocks, you will get stock certificates. But nowadays, everything is in dematerialized form. That is in electronic form. So whenever you buy a stock, the shares get credited in your demat account, and whenever you sell the existing stock, then the stock will get debited from your demat account. The next term is trading account. Trading account is a medium to buy and sell shares in the stock market. In other words, it is used to place buy or sell order for a share in the stock market. So let's say you want to buy shares of Tata Motors. So here you have to specify how many number of shares you want to buy. Let's say you want to buy 10 shares, 100 shares, 1000 shares, and similarly at what price you want to buy, maybe rupees 100, 120, 130, and all these details can be filled using the trading account. So if you want to trade in Indian stock market, you need to have trading account and demat account, and you can open all these account with the broker like Angel Broking, Zerodha, or any other broker. The next term is intraday trading. It is one of the most frequently used term in stock market. You might have also heard about intraday traders. So when you buy and sell the shares on the same day, then it is called intraday trading. So let's say you buy a stock in the morning at 9:30 and sell the stock within 1 hour, let's say at 10:30. So it is called intraday trading. And your shares are not purchased for investing, but to get profit by harnessing the movements in the market. So as you might already know that stock prices fluctuates. So let's say at 9:30 a stock price is 100 rupees, and at 10:30 its price moves to 105 rupees. So if you buy stock at 100 rupees and sell at 105, so you can make a profit of 5 rupees just within 1 hour. So that's what intraday traders do. They buy and sell the stock in the same trading session, that is the same day. They do not hold the stock for a long term. Next is delivery trading. So when you buy a stock and hold it for more than 1 day, then it is called delivery. Now it doesn't matter whether you sell it tomorrow, after 1 week, 6 months, or 5 years. If you hold the stock for more than 1 day, then it is called delivery. So two of the most popular type of trading are intraday trading and delivery trading. So intraday trading, when you buy and sell the shares on the same day, then it is called intraday trading. And for delivery trading, for the long term investor who invest for the long time, are called delivery traders. Now let us understand the concept of bull market. It is the term used to describe the scenario of the market. A bull market is when the share prices are raising and the public is optimistic that the share price will continue to raise. So, for example, let's say a company stock price is continuously raising for last 4 5 months. So you can say that stock is in bull phase. So as we discussed, this is the scenario in the market, and when the people are optimistic, everything is doing good, economy is doing better, and the stock prices are keep on raising, then this scenario is called bull market. On the contrary, when the share prices are falling and the people are pessimistic about the stock market, then it is a bear market. For example, if the stock price of a particular company is continuously declining for the last 3 4 months, then it can be considered as a bear market. Here, the people are fearful and thinking that the market will continue to fall, and hence they start selling their stock. However, an important point to mention here is that no market can last forever. Bulls and bears are part of the market. Bull market is always followed by bears, and the bear market is always followed by the bull. Now let's understand another important concept, that is market capitalization. It refers to the total market value of the company's share. It is calculated by multiplying the total number of shares by its present market share price. For example, let's say there are 100 crore shares of a company, and each share is traded at 5 rupees per share. Then the market capitalization of that company will be 100 crores into 5 rupees, that is 500 crores. Market capitalization is used to define large cap, mid cap, and small cap companies. For example, If the market capitalization of a company is greater than 29,000 crores, then it is said to be large cap company, that is big company. On the other hand, if the market capitalization of a company is in between 8,500 crores to 29,000 crores, then it is said to be a mid cap company. And finally, if the market capitalization of a company is less than 8,500 crores, then it is said to be a small cap company. So, for the big reputable companies who have been in the market for a long time, like Tata Motors, Maruti Suzuki, HUL, and all these companies are large cap companies. On the other hand, startups, new business, they are generally in the small cap range. And all these divisions is based on the basis of market capitalization. Let's move to the next term. It is called limit order. Limit order means to buy or sell a share with a limit price. So as you already know that the prices of stock fluctuates every second in the stock market, and if you want to buy a share at a given price, you can place a limit order. For example, let's say the stock of Tata Motors is trading at rupees 180, but you don't want to buy at rupees 180. You want to buy it at rupees 178. So here you can buy a limit order, and when the stock price of Tata Motors fall from rupees 180 to rupees 178, this order will get executed. However, the problem with limit order is that sometimes your order might never get executed. For example, let's say if the prices of Tata Motors start moving from 180 to 184, 185, and even higher, then your order will never get executed. And in such scenario, you have to cancel this limit order and again place another order. On the other hand, market order. Market order is an order to buy or sell a security immediately. That is, when you want to buy or sell a share at a current market price, then you need to place a market order. So let's again, we can go back to the example of Tata Motors. So let's say its current price is rupees 180, and you want to buy the shares of Tata Motors at the same price, then you can place a market order. And the best part of market order is that it is executed immediately, that is instantaneously. Next is margin. Trading on margin means borrowing money from your stockbroker to purchase stocks. So let's understand this concept better. Let's say you buy a stock at 100 rupees and you sold the stock at 105 rupees. So here your profit is 5 rupees. However, this is very small profit. So here what you can do is you can get a money or borrow money from your broker so that you can buy huge quantity of stock. So margin basically helps the trader to trade in more stocks than they could normally be able to. So here the profit earned can be increased significantly. However, as you are borrowing money from your broker, again the risk also increases, because anyhow if you make money or if you lose money, you have to return that money to your broker. The next term is liquidity. Liquidity means how easily you can buy or sell a share without affecting the share price. A highly liquid share means that it can be easily bought or sold. On the other hand, a low liquid stock means that the buyers or sellers are hard to find. For example, big companies who has a lot of outstanding shares, then it is easy to buy and sell stocks. On the other hand, in a scenario where you buy small cap company shares who has a very less number of share volume and liquidity, you might be stuck with those stocks. So let's say you hold 1000 quantity of that stock and there is no buyer there, that is no one is ready to buy their stocks from you, then you might be stuck with those stock. So whenever you are purchasing any company shares, especially small cap company stock, check their liquidity. That is how liquid the company is and how easily you can buy or sell a stock of that company. The next term is trading volume. It is the total number of shares being traded at a particular period of time. So when a security is more actively traded, then trading volume is high. Now, higher trade volume for a stock means higher liquidity, better order execution, and a more active market for connecting a buyer and seller. So whenever you are purchasing a stock, always look at the trading volume. That is whether the volume of the stocks are high or low. Then the next term is volatility. It means how fast a stock price moves up and down. Now on a particular day, the stock price of a company can go up and down. And if the changes in the stock price is drastic, then it means that the stocks are highly volatile. More volatile stocks are considered as risky than less volatile stocks. Next term is short selling. In the stock market, you do not always need to first buy and then sell stocks. Sometimes you can first sell the stock and then you buy. And this concept is called as short selling. It is a practice where the trader sells shares first, which he does not even own at that time, and hope that the prices of that shares start falling. The trader will make a profit by buying back those shares at a lower price. So let's say there is a company whose share price start falling. So here you can first sell the stocks at 100 rupees, and later when the price falls to 95 rupees, you can buy back that stock. And here the difference in the buying and selling, that is 100 rupees and 95 rupees, is your profit. That is 5 rupees is your profit. So lot of people use this technique of short selling to make profit in the falling market. That is in the scenario when the share prices are continuously falling. The next term is average down. This is an approach that investor use to buy more shares when the share price start fluctuating. This results in an overall lower average price for that stock. For example, let's say stock prices are continuously falling and you are not certain at what price you should buy that stock. So you can buy that stock in different prices. So let's say you bought 10 shares at 100 rupees, and after few days prices of the stock fell, and you bought the stocks again at 80 rupees, right? And the prices again kept on falling. After few days, you again bought the stocks of that company at 60 rupees, right? So here your average buying price will be 80 rupees. That is 100 plus 80 plus 60 divided by 3. So that is 80 rupees. Here, as you can see that it is the lower than the original price. Here original price is 100 rupees and your average price is 80 rupees. So average down helps an investors when they are uncertain about the purchase price, or when the prices of the stocks are fluctuating drastically. Now let us understand another important term, that is portfolio. A stock portfolio is a group of all the stocks that you are holding. So let's say you are holding 10 stocks of HUL, 20 stocks of Apollo Tire, and 20 stocks of Maruti Suzuki, and 50 stocks of Titan Company. So all these companies are in your portfolio. And the portfolio shows that the different stocks and the quantities that you are holding. And it is very much important to build a good portfolio to maintain the risk reward in the stock market. Suppose you have some risky stock in your portfolio, you should also keep some less risky stock of large cap companies so that you can balance risk and reward. Therefore, it is really important to make good portfolio if you want to get consistent returns over long term. The last and final term is dividend. So whenever a company is in profit, it can either reinvest their profit, that is, it can buy more assets, more property, or expand it in new countries, or it can distribute its profit among its shareholders. So this share of profit that is distributed by the company to its shareholders is called dividend. So let's say a company made a profit of 100 crores in a year, and they decided to distribute, or they decided to share 40 crores with its shareholders. Remaining 60 crores they'll retain with them, and there are a total 4 crores of shareholders in that company. And so for every share, the shareholder will get dividend of rupees 10, right? However, an important concept to understand here is that the company is not obligated to give you dividends. For example, the growing companies who are investing profit for expanding their business, then they might not give you any dividend. On the other hand, big companies which are already well established and matured, who don't need much money for their expansion, they might give a very good dividend to its shareholders. A lot of government companies, utility companies, petroleum companies, they give very good dividends to their shareholders. And this also a way to gain passive income directly into your bank account. So let's say you own 100 shares of a company and the company is consistently giving a dividend of rupees 2 per year and also increasing the dividend every year. So this 2 into 100 rupees, that is 200 rupees, you will get directly into your bank account. So that's it for this session. In the next session, we are going to discuss about fundamental analysis.